19 odd percent. Thanks a lot, Mr. Patel, for joining in. Current margins are around the 13% mark. You have a target of 17% by FY25. What do you think will change for the company to do that 17% margin on a much higher revenue base?
Firstly, good morning and thank you for having me. I think the two levers that we believe will help us improve our margin profile is one, obviously, in glass-lined segment, which we are the market number one. We hope to increase profitability by two levers. One is obviously operational excellence. We have two new factories, one in Germany and China, brand new, much more efficient, much smaller in terms of footprint. We expect these factories to gain more momentum and turn profitable over time. The other area is obviously value sourcing, right? So buying equipment from India, selling it into European and US markets, that's a big and significant area where we believe that margins can improve. The other area for us is the service business. Service, again, they currently accounts for about 30% of our total revenue. We believe a big push in the services area, especially in India and China, can help us improve margins going forward.
All right. Hi, Tarak. A couple of questions on that parameter. Services, you said it's around 30% of your revenues?
Yes. Internationally, it's about 40%. In India and China, it's about 10 or 12%. So there's a big scope for improvement here in India and China, especially with the installed base that we have. Every quarter, every year, we ship about 2,000 equipment in the market. So all these equipment eventually will come back for servicing.
All right. So services as a percentage of your revenue, where does that number move to? That's point number one. And also the second factor I wanted to ask you is you get around 35-40% of your total revenues from Europe, if I'm not mistaken. There's a gas crisis out there. Isn't it hitting business, or have you sourced your gas from alternative sources, or your power consumption? Go ahead.
Yeah, so energy costs are definitely a concern, but just to kind of give you an idea, 1/3 of our revenue comes from the US, 1/3 from Europe, and 1/3 from Asia. So Europe is about 30%. Energy costs are definitely a concern, but what's working in our favor is definitely that commodity prices have reduced, steel costs have come down. Luckily for us, the furnaces in Europe are not running on gas. They're running on electricity. Electricity is also seeing an upward trend, but hopefully we believe that this should start seeing some kind of cooling down in the next few quarters.
Well, that's a hope that everyone has, that there should be some sort of cooling down. But there is no visibility on that yet. Could you give us a sense of how much your European business can be hit this year itself because of this? And at the same time, with the rising energy costs, will that impact your margins? Or is there a clause that you will pass on all the increasing costs to your customers?
So I don't think we can pass on all our costs to our clients. I think there's definitely the potential to pass on most of it, but not all of it. Again, like I said, we've already put in measures to make sure that our costs are under control. So we are looking at maybe longer working days, maybe one day off. But luckily for us, the German and the UK facility, even though they have been hit by the energy costs, increases over the last few quarters, we haven't seen a big reduction in profitability.
So with all of this, with all of this, what does it mean for this year itself? We have your 2025 vision, but this year, with the kind of dynamics that we're seeing in the world, last year you did about 2,500 crores of top line with 11% margins. Do you have a sense of what this year can be with the potential risks?
So I think with the order book that we have on hand, we still expect to grow. We don't expect a big change in terms of guidance. And like I said in the analyst meet a few days ago, if we do track towards 17%, we will have to see some improvement. The European business is around the 10-12% mark, so we don't see a big reduction there. There could be a short-term impact due to higher energy costs, but I don't think that's going to have a big impact in this year's performance.
All right. And you're adding capacities, as you said, the new facilities you have, I think, in Germany as well as in China. So at peak levels, what kind of revenue potential do you have? And also, if you could give us a sense, you've mentioned numerous times that in the segment that you're operating in, you're the number one player. Give us an updated market share, and where does that move to in the segments you operate?
Yeah, so glass-lined business, I would say we have a market share at about 40% internationally, a little bit more here in India, closer to 50%. So we are by far the biggest the company in terms of glass-lined. I think we are 50% bigger than the competitors. So significant size and scale here. We have added capacity, like you rightly said. Germany and China are definitely doing much better than what they were doing a few years ago. In India, we've added new furnaces. In Brazil, we've added new furnaces. We just acquired a company in the southern part of the US, where we've also added glass lining the capacity for servicing. So we are looking at M&A as an opportunity to really grow the business. And like I said, services, again, is an important part of our business. So that's really where we want to be closer to our clients, to our customers so we can be much quicker and faster in terms of response time.
Tarak, very quickly, what is your revenue potential?
So revenue potential, so when we do say 3,700 crores, this is really organic growth without, and we still kind of expect the M&A to kind of add to that. So 3,700 is purely based on what we currently have.
And that's the peak revenue potential? That's the peak revenue potential with all this current capex that you're doing? Peak is the 3,700 or you could do maybe 4,000 crores by 2025, but you're saying that, you'll achieve 3,700 or is it peak level?
Yes. So I think peak level, like you said, is around 3,700 with no more investments. But, obviously there could be a change in the product mix, pricing and things like that, which impacted, probably northwards a little bit. But, you can take 3,700 as the full capacity. Yeah.
Could you give us a sense of how big in that will your non-glass line segment be?
So that's a good question. And I think we are moving away. Like I said, market share of 40% glass line, gaining market share is tough and it will come at a cost. So we do believe that the revenue growth levers are really the non-glass line business where we have lower market share. So by the end of maybe 2025, we believe services and systems and non-glass line business would account for nearly more than 50% of our total revenue. And that's what we are planning to do.
Final question then. When are you increasing your stake in GMM International? Is that on the cards? And how does that change the overall things for the company in terms of shareholding pattern, if at all?
Yeah, so in 2020, we bought 54% of the international business. Just a month ago, we announced the balance acquisition of the 46%, being a related party transaction. The minority shareholders already did vote on this, and it's approved now. So maybe in the next 2 or 3 weeks, we will complete the acquisition based on some UK kind of filing requirements. But that's pretty much done now. So India is now owning 100% of the international business, full flow through of profitability, and that structure has been cleaned up and make it, just they make it simple for everybody now.
Okay, all right, Tarak, thanks so much for stopping by and filling us in with your quick uptake on business. You didn't give us a near-term revenue growth, but you've given us a 2025 vision. We look forward to chatting up with you rather soon.